We've got Sriram Ramanathan, Head Fixed Income at L&T Investment Management, who now joins in on the show. Thanks very much for being with us, Mr. Ramanathan. Now, to start off with, you've got the bond yields which are at over 3-week highs. What's the kind of range that you're factoring in now?
Yeah, hi. Thanks for having me on. Overall, I think post the budget, clearly bond yields have moved with a slightly upward bias. I think before the budget itself, to the extent that the government had already prepared the markets for the numbers, there wasn't too much surprise on the, let's say, the fiscal deficit or the net supply. I think the one thing that did come as a surprise to the market was the bond buyback, which in turn has pushed the gross supply higher for this for the coming year. I think to that extent, the duration supply in a way, because you are replacing bonds with a 1 to 3 year maturity with bonds of 15 years, which is what the government has come out with. I think that is going to be a bit of a challenge in terms of the market to absorb. And finally, it again comes down to at what point RBI gives clarity on its open market operations for next year and how much of the supply really goes to them. So I think these things are being digested by the market. So to that extent, yields have edged up a bit higher. But the primary backdrop, I think, still remains one of slowing growth. I think RBI, to some extent, has to come in to support the economy. Of course, they are constrained by a few factors, primary being current account deficit and also the low savings rate. But finally, I think the rate cuts and really form the backdrop of the economy right now. So what I view is that there's a minor correction. Yes.
For the liquidity situation, what is your expectations as to how much we'll get through the OMO operations?
For this year or for next year?
For this year.
For next year.
For the next year.
This year, actually, they have been continuing. So I believe the estimates are already close to 1.4 lakh crores in terms of what they have done. I think for next year too, given the supply that is there, I would expect anywhere between 1.2 to 1.4 lakh crores as the extent of open market operations from the RBI. I think that should finally, the only question is in terms of timing and at what point the market gets to know about the certainty of that. I think that's where the volatility comes in.
And most of the dealers believe that the government's clarification on the buyback being outside the borrowing calendar has already been factored in. Would you concur with this statement?
Yes, broadly. I think the government has seen the impact that that has had on the bond market. So clearly, a few clarifications have come. But really, even keeping that aside, I think the supply is there for next year, which is fairly high. So to that extent, yes, the bond buyback, to the extent that it is going to be subject to various things and really a swap, not really the issuance preceding the buyback. I think that gives a bit of comfort to the market. But really the market probably is looking for a few more signs from the RBI. I think the upcoming inflation prints that come up and the March 19 policy, RBI policy, I think that is what will probably give a little bit more comfort to the market.
Okay, just wondering what's the internal sense on what the rupee could do over, say, the course of the next 1 month? There is pronounced weakness over the last few sessions, sub 55 today. Where can it head?
Right. Yeah, I think broadly, clearly that's one of the big vulnerabilities for India. And I think that's going to come up as a challenge for the RBI increasingly as well, in terms of to the extent they are able to ease rates is really constrained by what is happening on the rupee and the current account. Given that typically these kind of trends on the export-import side to really change takes time, and I don't see a real immediate reversal on either of those. So it does mean that, yes, the currency is going to be under pressure from the trade flows from the current account side, and we are going to be a lot dependent on the really the equity flows coming in from outside. And overall, I think I would expect a slight upward bias to the rupee over the coming few months.
Sriram, just to dwell on the points that we were talking about, the OMO operations, do you think that given the current liquidity situation, the RBI is likely to cut the CRR rates in its macroeconomic policy, or will it continue to manage the liquidity via OMOs itself?
Yeah, actually, if you see, for example, today's LAF number has come off a lot. So clearly, I think the primary thing is in terms of at what pace the government spending really comes back into the system. I think we have been seeing for quite a few months now, government surpluses have been very high. So if you really put the government surplus along with the LAF deficit, for example, the number isn't really alarming. So it's really a function of at what point the government spends a lot and money comes back into the system. Personally, I do think that a fair bit of the spending which has been back-ended and which has already been budgeted into the revised numbers is going to come back into the system. So I do think the liquidity situation will improve a bit on the margin. So coupled with a few OMOs, I think that is the way I would think RBI would be looking at tackling the liquidity situation. Yes, around March 15th, after the advance tax, liquidity deficit would increase. But that's pretty much factored in by the market. So I don't think that itself will call for a huge measure from the RBI.
Great, Sriram. Good having you. Thanks much for joining in and giving us your perspective.